When it comes to investing, sometimes your strategy may be determined by the nature of the market. Is it a bull market? Is it a sideways market? Is it a bear market? So all these kind of trends will determine precisely the kind of strategy you are going to adopt. And so investing in the bull market is characterized by rising stock prices and overall pessimism or rather optimism. In the bull market, you have inherent, investors become so pessimistic. When it comes to a bull market, investors are kind of optimistic. When it comes to a bear market, investors become kind of pessimistic. So this can present excellent opportunities for growth. So here's how to effectively invest in a typical bull market. So what strategy are you going to adopt when you come across a bull market? So in this case, number one is a focus on growth stocks. In a bull market, you focus on what? You focus on growth stocks. In this case, these stocks have high potentials. Look for stocks with high growth potentials as they are likely to benefit the most from a rising market. So growth stocks tend to, rise at an above average rate during a bull market. So, identify them and invest in them. So you also consider innovative companies. So consider investing in companies that are leading in innovation or emerging industries such as technology or clean energy. Number two is utilize momentum investing. You can key into momentum investing. So in this case, you try to identify trending stocks, that are trending, benefiting from the market trend. So identify stocks that are trending upwards and showing strong momentum. Use technical indicators like moving averages or relative strength index to spot these trends. You equally have the concept of buy high and sell higher. You buy high and pray that the stock moves higher so you can sell at a higher price. So momentum investing often involves buying stocks that are already performing well with the expectation that they will continue to rise. In a typical bull market, they do rise. Number three is diversify your portfolio. So you may incorporate sector diversification. So invest across various sectors, to spread risk. Even in a bull market, some sectors may outperform others. In a typical bull market, some sectors can still do better than other sectors. Identify those sectors that are doing well and invest in companies in those sectors. You equally have asset allocation. So maintain a mix of asset classes like stocks, bonds, real estate, commodities, mutual funds, hedge funds, venture capital, and other related asset classes. And this will help you to balance risk and to maximize your return. Number four is consider sector rotation. Consider sector rotation. So in this case, you have to bring in or be fully aware of economic cycles. So rotate investment into sectors that are benefiting from the current phase of economic cycle. For example, technology and consumer discretionary sectors often perform well in a bull market. Not only that, you consider growth opportunities. Identify sectors with strong growth potential and allocate more funds to those areas. Number five is use leverage cautiously. Utilize leverage with caution. In this case, I'm talking about margin trading. In a bull market, leveraging, can amplify returns, but it also increases risk. So use margin trading cautiously and ensure you can cover potential losses. Be very careful the way you utilize margin trading, the way you utilize leverage when it comes to trading as an investor. So risk management, have a clear plan for managing leverage and avoid excessive risk taking. Number 6, invest in high quality companies with strong fundamentals. Focus on companies with strong financials, including solid earning growth, low debt level, as well as a competitive advantage. You also have this particular, you consider long-term potential as well, long-term potentials. So look for companies with a sustainable business model and long-term growth potential with an excellent economic mood around it. Number 7 is set realistic goals and targets. Set realistic goals and targets. In this case, establish realistic price targets for your investments and consider setting trailing stops to lock in gains as the stock appreciates, as the price appreciates. You also take into consideration, profit-taking strategy. Have a plan of taking profits when certain stocks or sectors reach your target price. There's no harm, in locking in your locking in your gains. Number 8 is monitor market trends. In this case, you consider economic indicators. Keep an eye on economic indicators such as GDP growth, interest rates, and inflation, which can impact, market conditions. You also consider market sentiments. Stay informed about market sentiments and news that may affect investor behavior and stock prices. It affects stock prices. Sentiments, unfortunately, not even fundamental, even sentiments in the market tends to affect, investor behavior. Please like this video, subscribe to this channel if you've not done that. Number 9 is avoid overexposure. In this case, you talk about risks of overinvestment. Be cautious of overinvesting in high-performing stocks or sectors. Diversify to avoid excessive exposure to any single investment. There's no 100% guarantee or assurance in the market. So make room for that particular fact that an investment can can take a negative downturn. All right. And so maintain balance. Ensure your portfolio remains balanced and does not become too concentrated in a particular area. Maintain balance and incorporate a decent level of diversification. Number 10 is prepare for market correction. Prepare for market correction. Be cautious. All bull markets, can eventually lead to, market correction or downturn. Be prepared for potential market shifts and have a strategy in place to manage risk. Stocks don't grow to the sky. They will eventually come back. Bull market don't last forever. Eventually, it might, it might metamorphose into a bear market or a sideways market. So equally talk about, equally incorporate rebalancing. Regularly review and rebalance your portfolio to maintain your desired risk level and investment goal. And so in summary, investing in the bull market involves capitalizing on rising stock prices by focusing on growth stocks, utilizing momentum investing, and diversifying your portfolio. Consider sector rotation, use leverage cautiously, and invest in, high quality companies with strong fortress balance sheet. Set realistic goals when it comes to your price targets and monitor market trends. Avoid overexposure and prepare for potential correction. because stocks don't grow to the sky and bull market don't last forever. By implementing these strategies, you can maximize opportunities and manage risk in a bull market effectively.